So it's another great evening to meet for this session of advanced financial reporting and analysis. So we are going to do a question of internal reconstruction, that is May 2014. So we go through, we check what the examiner was in need of us to do so that we present in the whiteboard. So I think I have shared that one to your group, so you can check if it's the question which you don't have, you use that one. So they were saying that Wonderful Limited is a company that carries on business in the entertainment industry. So for the past few years, the company has been making losses owing to the low prices charged by competitors. So the company's statement of financial position as at 31st December 2013 was as follows. So it has been making losses owing to low prices charged by the competitors. The company statement of financial position as at 31st December 2013 was as follows. So we have this statement of financial position of that company, which was doing what? Making losses of that relevant company, which was making losses. So you don't have to read this statement, but you can see the retained earnings is negative. Obviously, it will be negative because now it's not a company which is operating at profit. If it's operating at profit, we are not even supposed to do reconstruction. So which proportions did they come up with? So the company has changed its marketing strategy, is now hoping to attract more customers. So it's expected that the company will earn annual profit after tax of 1.5 for each of the next 5 years. So this figure is before interest charge. Income tax is assumed to be at the rate of 30%. The directors are proposing to reconstruct the company and have drafted the following proposal for discussion with shareholders. Number one, to cancel the existing ordinary shares. 11% loan notes are to be retired at the holders issued in exchange with 3,014% redeemable notes 2025 and the 2 million ordinary shares of shillings 0.25 each fully paid down. Number three, the carrying value of the preference share capital above include 4 years of the dividends arrears. So the preference shares are to be issued with 2 million ordinary shares of shillings 0.25 each fully paid down in exchange for the cancellation of those dividends arrears. Number four, the existing ordinary shareholders will be issued with 3.5 ordinary shares of shillings 0.25 each fully paid up. Number five, in the event of liquidation, it's estimated that the net realizable value of the assets will be 3.1 for the non-current assets and 3.5 for the current assets. So required statement of financial position as at 1st January 2014 after reconstruction has been effected. Number B, computation to show the effect of the proposed reconstruction scheme on loan note holders and ordinary shareholders. So that is what is required. Even if in this question they don't require journal entries, we have to do the journal entries. So that is what will assist you to do this question. So you have to start with the journal entries, meaning that your journal entries will be like workings to record the proposals which were brought upon by the shareholders. So the directors are proposing to reconstruct the company and have drafted the following proposals for discussion with shareholders. So we have to recognize these proposals because they are now the main solutions to make the company move out of losses. So let's recognize them in a journal entry very fast. We do maybe reconstruction, not a capital reduction account, sorry, and an ordinary share capital account. So that is okay. So May 2014. Question 2. So we do the channel entries. We do the channel entries. So we have the, we have the debit and we have what? Credit. I think you are seeing what I'm writing on the board. There's no challenge from your end. If there's a challenge, you let me know. I can adjust what is required to be adjusting. So yesterday I mentioned something here. When we are doing the channel entries, which is the first 2 entries you are supposed to do? This is a question to you guys. What is the first thing I'm supposed to do? Christine, what is the first thing I'm supposed to do? Which is the first channel entry I'm supposed to do? I said we do what? Anyway, let me do my work. So here, the first thing we do is all about to cancel that the old par value. The par value, the shares were stated that when the company was operating at losses. So you can see our shares are stated at 1 shilling each. So we are considering now that price to be high. So we want to attract more investors to come in and tell them that it's not only that we have reduced our prices, there are other changes we have done. So that price must be reduced. So checking in the additional information I want to see, they reduced it to what? So if you are careful, the first additional information, that is what they say, to cancel the existing ordinary shares. Then, in additional information number 2, they were retiring 11% loan notes and giving out 3 million redeemable notes and 2 million ordinary shares, stated at what? Shilling 0.25. Even in note 3, the preference shares include 4 years of the dividends arrears. So the preference shareholders are to be issued with 2 million ordinary shares of shillings what? 0.25. Even in note 4, the existing ordinary shareholders will be issued with 3.5 ordinary shares of 0. So meaning that the price has been reduced from 1 shilling to what? The price of a share.
0.25.
Yes, that is the case. So the price has been reduced from 1 to 0.25. So let's cancel first the shares stated at 1 so that we write them or we record them at a new price. That is 0.25. So we write off them, then we record the same shares at 0.25. So meaning that the capital was 10,000. That time, our value was 1 shilling, meaning that this is 10,000 shares. So I will cancel this, then record those shares at what? At 0.25. 0.25. It will be 20 what? 2,500. So to cancel the 10,000, which was stated at a par value of 1 shilling, remember that I said the capital account will be debited or credited. The capital account will be debited or credited.
Debited.
Debited. So you debit the ordinary share capital. $10,000. You credit what? Capital reduction.
Capital reduction.
You credit the capital reduction. So here you say to cancel the old class of ordinary shares. To cancel the old class of ordinary shares. And now we record them at 0.25. So now here you will come and do what? Debit the capital reduction. So 2,500. Not 2,500 is just 10,000. times 0.25. Credit ordinary share capital. So 2,500. So to record new class of ordinary shares. So that is the additional information number one. And try to maintain silence. Try to maintain your mic, whoever is unmuted. So additional information number two, they say, so we are done with additional information. The proposal number one, that is. Proposal number two, the 11% loan notes are to be retired and the older issued in exchange with 3 million 14% redeemable notes and the 2 million ordinary shares of 0.25. So you retire the 11% loan notes. Then you exchange with what is given there. So meaning that for you to retire the 11% loan note, will I debit that account or I credit that account? The liability account, the 11% loan note account. Will it be debited or credited?
Debit.
Yeah, so because it's a liability for us to retire it, we debit 11% loan note. 11% loan note. So the value of the 11% loan note is 3,500. So it was retired and they were issued with what?
3,014% redeemable.
14% redeemable?
Notes.
Redeemable loan notes. 3,000, eh?
Yes.
And ordinary shares, eh? So the ordinary shares, the number of ordinary shares were 2,000, eh? From that question of 0.25 each. So what do you have? 2,000 times 0.25.
500.
So 500. So you can see it's balancing it. So you say on retirement of 11%, on retirement of 11% loan notes. And the retirement of 11% loan notes. And so the next theme was by the examiner. Tabitha Wanjiru, mute your mic. Mute your mic. So the next thing is all about additional information number 3. The carrying value of the preference share capital above include 4 years of the dividends arrears. So the preference shareholders are to be issued with 2 million ordinary shares of 0.25 each, fully paid up in exchange of the cancellation of this dividend. So the carrying value of the preference dividend of the preference share capital. Carrying value include 4 years of the dividends arrears. So the carrying value is 33 of the prevalent shares. So the 8% cumulative prevalent shares, 2,500 shares. Per share is 1. So 2,500 times 1, that is 25. But now the carrying value is 33, meaning that the one which are in arrears is just the difference. That is why they say the carrying value includes the arrears. Include the arrears. So that is for 1 year. So 3,300 minus 2,500, what do you have?
800.
800 times 4. 4 years, that is
3,200.
3,200. But now, since I'm preparing just for 1 year, I don't have to use 4 years. With my books, the ones which I'm preparing is just for 1 year. So I will consider just the dividends which were in arrears for this year only. The 3,300 minus 2,500, so the 800 for that year. Even if they said yes, they were in arrears for 4 years. Remember that I'm preparing my books for just 1 year. So they accepted what? So for those dividends to be settled, or if you take 8% of 2,500 is 8% of
200.
200. Oh, so there's something I wanted to confirm.
200.
Of which I will do what? It means that it's not just for 1 year, but the dividends which we have determined are for 4 years. So I will draw my first statement. So it means that what they gave us here was just a short contribution. So because they have given you 2,500 shares, per share is 1. So the carrying value is 33. So meaning that if you take 33 minus 2,500, you get the direct 800 for 4 years. Yes, and we need to consider it for 4 years. It's the same as if I take 8% times 2,500 times 4. You get 800. Senior. So the dividends in arrears for the 4 years is inside there. The 800 direct by taking 2,500, 3,300 minus 2,500, or you take 8% times 2,500 times 4. So they accepted. So for this to be compensated, they accepted to be given what? Or before I mention, they accepted to be given what? What am I supposed to do with the 800? Am I supposed to debit or credit? So remember that this is in the preferred share capital account. This one will be settled, yes, by them being given something. So for them to be in the preferred share capital account, will I debit the 800 or I credit?
You debit.
Yes, I credit. But I credit with what they were given, what they accepted. So the preference share capital, preference share capital. So you say 8% times 2,500 times 4. So we have the 800. So they accepted what and what? You have the question. So I'm expecting the limit answer. So they accepted to be given what and what?
Ordinary share capital.
So ordinary share capital. The number of ordinary share capital. The number of ordinary shares. Number of the ordinary shares they were given is the number.
2,000.
2,000.
2,000. Yeah.
Times 0.25.
0.25. Yeah.
Yes. So 2,500 times 0.25. This is 500. That is 500. But you consider it's not balancing. So for us to balance here, is that main account I said, we always present when we are doing a reconstruction, which is capital reduction. So you will credit with capital reduction for it to balance at 800, both on the debit side and on the credit side. So that is it. So that is the explanation you give is just what you have done on the compensation of what? The previous dividends, which were in arrears. So you have to give the narration. So before we go to the next additional information, I can write the narration. So you can say to settle. So this one to settle the previous dividend arrears. But in an exam situation, we don't expect your explanations to be the same, but the meaning can be the same. So there's no way someone can write the same sentence with yours. The wording. So I could have even say that on settlement of the previous dividends arrears to the previous shareholders. So it's all about what you have done, is what you explain as a narration. So the next is all about, I think it was subscription. The next additional information was concerning what? So additional information number what? Additional information number 4. The existing ordinary shareholders will be issued with 3.5 ordinary shares of 0.25. So the company is issuing shares to the shareholders. So meaning the company will be receiving what? Or what am I supposed to debit and what am I supposed to credit? What will I debit here?
Capital reduction.
No, understand that statement. The company is doing what? Read that statement, someone. It's not all about capital reduction every time from now to 10.
Cash book.
Cash book. Remember that? The company is giving out shares to the existing shareholders. So meaning the shareholders are buying the shares. So the company will be getting money. So cash book. Then you credit the ordinary share capital. So the number of shares were 3,500 times what? 0.25. Give me the answer. Those are the number of shares which the company issued. 3,500 times 0.25.
875.
875. So that is 875. So you say on a new issue of shares, to the existing shareholders. Eric, I think we are talking about something called a rights issue. Here we don't have a rights issue. A rights issue is when the company issues shares at a lower price than the existing market price based on a certain proportion. Have you been told concerning any proportion they were issuing? The shares to the existing shareholder? No, they have not mentioned anything about that. So then the next additional information, number 5. In the event of liquidation, it's estimated that the net realizable value of the assets will be 3.1 and that of non-current assets will be 3.1. So there's this aspect of assets. So we say we check if there's a positive adjustment or a negative adjustment on those assets. So in the event of liquidation, it was estimated that the net realizable value of the assets, could be 3.1 for non-current assets. So 3.1 for non-current assets. So the non-current assets initially were stated at 3.6. So they are now stated at 3.1 after that fair value adjustment, which is done. So which is a negative adjustment. So the difference, 3,600 minus 3,100, that is 500. So that is a negative adjustment. So in the assets, you credit, you debit capital reduction. So debit capital reduction. That is 500. Credit the non-current assets. So that is 500. So that is okay. So you can say this one on negative fair value adjustment. On negative fair value adjustment. On the negative fair value adjustment of non-current assets. And even for the current assets, it was a negative adjustment.
Yes.
So from so by the difference is by which figure? So in the statement of financial position, the current assets was stated at
47.75.
then under the additional information that they stated to
3,500.
So the difference is
12.75.
12.75. So that is what is here. So in the statement of financial position, the current assets 47.75. Then down there in the additional information 3,500. So the figure you have said is 12.75. The negative
Yes.
adjustment. So we debit capital reduction. We credit current assets. So this is 12.75. 12.75. So here you say on negative fair value adjustment. Of current assets. Then, is there anything remaining in that additional information? So, is there anything remaining in the additional information? So we are done with the additional information. So the only thing I have to record here again is these accumulated losses. So we have to write off. Even if you are not told, you have to write off. Because now we are reconstructing the entity from making losses so that it start making profits. So the accumulated losses must be written off. In some questions, like now the one we did yesterday, we were told we write off. But if you are not told to write off, you have to do that. So I say the accumulated losses, it's considered as an expense to the entity. Expenses are debited. For us to write them off, we credit that account. We debit capital reduction. So meaning that I will debit the capital reduction. And the credit accumulated losses. So which is a retained earnings account. So the figure was 94.25. So you say to write off accumulated losses. So up to that point, we are done with these journal entries. And now the next thing we do is capital reduction account. Capital reduction account. Beside the capital reduction account, I do which account? The ordinary share capital account. So the balance brought down from the statement of financial position was 10,000. In the first journal entry, it was concerning writing off the 10,000, which was stated at a par value of 1 shilling. So we debited ordinary share capital. So meaning that our ordinary share capital will be debited with capital reduction. So it was 10,000. Then we credited what? This account with ordinary share capital. This from the channel entries you have. This is what we did. The capital reduction is on the credit side. And the ordinary share capital is on the debit side. That is the first channel entry we did. Then the next channel entry, we credited this account. I remember it was with 2,500. But now we say capital reduction. Capital reduction. Then this 2,500 was on, in this capital reduction account, it was on the debit side. We debit, so the ordinary share capital. So the 2,500. The second entry was concerning 11% loan notes, which was retired. It was on the debit side. Then what was on the credit side? It was retired with what and what? 11% loan notes and ordinary share capital. So the ordinary shares, so we have to record here. So 11% loan note is the one which is on the debit side. But our ordinary share capital on that credit side is the 11% loan note was retired and they were given ordinary shares of which value? They were 2,000 of 0.25 each, which gave us a value of
500.
500.
the third channel entry was concerning the dividends arrears. So we debited the preference share capital account. We credited what? They were given shares. So preference share capital here we credit. So this account will be credited. The ordinary share capital will be credited with the preference share capital. Because when this preference share capital were being compensated, when the dividends which were in arrears were being compensated, the preference shares, the preference shareholders were given ordinary shares of which value?
2,000.
2,000.
500.
Giving us a value of 2,000.
800.
So 2,000 was number of ordinary shares times
Times 0.25.
we got
500.
500.
500.
And the third journal entry was concerning the third journal entry is this one, whereby the company issued shares. So meaning there is this ordinary share capital. So the number of shares we issued is 3,500 times 0.25. So meaning that our capital must increase by this. But now we cannot say ordinary share capital here. So we say cash book. What's on the debit side? So the 875.
Mwalimu, a quick one. when we were having the preference share capital of 800,
there was capital reduction.
there was capital reduction of 300.
Credit side,
Yes.
or credit side of 300. So meaning that I debit was, I credit here 300. What is on the debit side? Preference. And that is fine. That is good. Should be for that correction. So we are now here. I think we have recorded so far everything. So there is this capital reduction, which is on the debit side of 500. So we have to record it on the debit side, but with non-current assets. Then this one, there is another capital reduction, 1275, which is on the debit side. But we have to record it with current assets. Then there's this 9425. We say accumulated losses. So far, we have not recorded it. We have not left outside anything. So the balance carried down here. And here, if the balancing figure is on the credit side, is goodwill. If it's on the debit side, is capital reserve. So let me admit your colleagues. So the balance carried down, ordinary share capital. That is this one I'm getting 4375. The balance carried down. So meaning that this is 14375. So the balancing figure here is on the debit side or the credit side?
The debit.
So the figure is? The figure is? Because the total I can see on the debit side is 13. So the total here is 13,700. So 13,700, meaning that it's a goodwill here.
700.
Which is? Which is 34.
3,400.
Yes. That is the relevant figure you have there, 3,400. So once we are done with this work, we can do now the statement. We can do that statement of financial position.
Excuse me, is the goodwill 34 ama it's just 400?
34. So this is 10,000 and this is 300. So if my debit side is 13,700, 13,700 minus 10,300 is?
Oh, okay. So
I think you are done with taking notes. So we do the statement of financial position. We do the statement of financial position. So we say wonderful limited. So wonderful limited statement of financial position. So statement of financial position as at what? So remember that our financial year, so before you and I write that date, let me check. So it's the statement of financial position as at 1st January 2014. That is after reconstruction. After reconstruction. So after what we have done. Was this statement given here as at 31st December 2013. So by the start of the next year, the new year, it will be a reconstructed company. And we show the effect of reconstruction to the loan note holders and the ordinary shareholders. We show that effect. So 1st January 2014. So it's an opening statement of financial position. This is an opening statement of financial position. So yeah, it's all about shillings in houses. So for the non-current assets, they were restated to what? They were restated to
31.
3100. And now we have goodwill. Goodwill is part of the assets. So this one, 34. Then we go to the current assets. So for the current assets, we talk about, they were restated to 35 plus 875, which 875 is when the company issues shares, it received cash of 875. You know that 875, the cash of 875, when you are recording cash in the statement of financial position, that is classified as a current asset. Beside trade receivables, inventory, cash in hand, bank balance, and the prepayments. So that 500 plus 875. 43. So total assets. So we talk about equities and liabilities. So ordinary share capital, we did an account. So ordinary share capital, the balance carried out was 43.75. So
Yes.
Anything else to be recorded under equity? Nothing. Non-current liabilities. So remember the loan, which was what we have been doing in short to make your work a bit easier. You understand what I've been doing. I have been following this statement, which is here, where recording new items after reconstruction. Like now, non-current assets, they were restated to a different value given in the additional information. The same way with current assets plus the additional cash. Under equity, remember we did an ordinary share capital account. For the retained earnings or accumulated losses, that one was written off. We don't have to record. We are reconstructing the company. There's no point again, you can record these accumulated losses. We are written them off. Non-current liabilities, the 8% preference shares. Remember that they talked about them being given what? Based on the one which were in arrears. They were given ordinary shares. They were exchanged with the ordinary shares. The dividends which were in arrears. So meaning that that this preference share capital So the dividends which were in arrears at that point, they received ordinary shares. So our ordinary share capital has been affected. So we recorded that at that point under the ordinary share capital account. So the 11% loan note was retired and they were given what? So in note 2, 14% redeemable notes and ordinary shares. For ordinary shares, we have recorded. So the 14% redeemable notes is the one I will record here. The 14% redeemable notes. So the 3,000. It was 3,000. The 14% redeemable notes. Yes. So you don't have any question concerning these preference shares because I can see there's something I'm supposed to record here. So remember that under that preference shares, was that total value of 3,300 just the dividends? Which value was dividends out of 33?
800.
800, meaning that that is the one which affected our ordinary share capital. So 3,300 minus 800 is?
25.
So meaning that we have to record 2,500. So the total amount, the 8% preference, yes. So the 2,500. Because the 3,300, the total amount was not just dividends, which they received some shares. So it was only 800 out of the 33. Out of the 3,300, it was just 800, which was dividends. And this one is here. They were given shares. For current liabilities, they never mentioned anything about it. So meaning that we record the way it is for the current liabilities. So current liabilities, that is 1,000. So total equity and liabilities. So your total assets,
10,875.
10.
875.
What about this?
10,875.
So that is how you were supposed to reconstruct. So at least this one was free. Hii lazima ungefikiria kidogo. Hata hii lazima ungefikiria. Even this one, it needed an account. This one was a bit tricky. Hii lazima ungefanya some workings. This one was a bit tricky. So most of them. So this one needed some. This question again needed some attention. It was not that direct. That is what you can see. So you needed to understand the concept of reconstruction for you to do it. So this the second part of that question. So we are not yet done. That question. So they are saying that we show the effect of what? The effect of reconstruction to who and who? So loan note holders. Loan note holders will be paid what? They will be given interest or dividends.
Interest.
And ordinary shareholders.
Dividends.
So dividends. So here, you need to understand the statement of profit distribution, how it goes. So that is what they were testing here. profit distribution, priority of profit distribution to the providers of capital. So priority of profit distribution to the providers of capital. So let's say we have a profit after tax of a certain figure. Who is paid first? Who has the priority of being paid first?
Preference shareholders.
Not the loan not holders. You don't pay external liabilities. Hmm?
The loan notes.
So you pay the interest to the loan providers. So you pay first interest to loan providers. So then after that you pay dividends to who? Preference.
Yeah.
Preference shareholders. And after now the balance goes to who? Goes to ordinary shareholders. Goes to ordinary shareholders as what?
Dividends.
Dividend. That is why when you are an ordinary shareholder, you hold common shares. You have that risk of losing your money in a company. It's not a must. You are not entitled to dividends. You are not entitled to dividends if a company is making losses. That is why the shareholders of KQ have been suffering from time to time. The shareholder of KQ, to have shares in KQ, in any company, it's not a big deal. So you can. It's not that it's a big company. You doubt you cannot have shares. You can own shares even at Safaricom today. Even at Kenya Power, you can. The money market thing. I know there are people who are very good in money markets. Make a good return out of that. So statement of profit distribution. So we do it now according to the question. So here, in this question of ours, they said something concerning, they gave us a certain proposal. They said that the company has changed its marketing strategy and is now hoping to attract more customers. It's expected that the company would earn, it's expected, it's just an expectation, an anticipation that the company will earn profit after tax of 1.5. Profit after tax of 1.5. This figure is before an interest charge. Income tax is assumed at a rate of 30%. The directors are proposing to reconstruct the company and have drafted the, so we are not concerned about the proposals. So we are now concerned about that 1,500. So this figure is after tax, so the 1.5. So the 1.5 is after tax. After tax. So if you raise tax, but no, this figure is before an interest charge. So if you raise tax on that 1.5, so that is it's already subjected to tax because they have saying profit after tax. So they are expecting to earn a profit after tax of 1.5. So meaning this profit after tax. So I will start from that point. So I give them what is what they were supposed to be given. So the profit after tax, that is 1.5. So there's the interest to loan providers. So after reconstruction, remember that after we retired the 11% loan notes, they were given, it's a 14% redeemable. Preference shares at 3,000. So if you take 14% of 3,000, what do you have? Fourteen percent of 3,000.
420.
Sorry?
420.
420. So that is 420. So minus 1,500, right?
1080.
10?
80.
8. So raise dividends to preference shareholders. So they were being given preference at what rate? Dividends are paid at what percentage?
8.
8%. So 8% of what?
$2,500.
So 8% of 2,500.
No, it's 200.
8% of 2,500. So 8% of 2,500. What's your figure? Hmm?
100.
That is? It's 8% of 2,500 because the 800 is the one which was in arrears. That one was already set through. So for now, I'm saying 2,500 times 8%. What is the figure?
200.
So 8% of 2,500. So that is 200. So you minus that. So you get what? 1080 minus 200?
880.
That is 880. 880. So this one is attributable to ordinary shareholders. So anyway, they were in need of the effect to the loan provider. This is the effect. And to who? To the ordinary shareholders. That is the effect. So they would be given 880, and this one were receiving 420. So that is what you could have done generally in this question of May 2014, question 2. So I will give out an assignment for internal reconstruction. There's a question I will have to give an assignment. And I would expect to see what you have done before next class. I will share that question with the group. So let me talk about external reconstruction a bit before 10, because I see we have a few minutes to 10. So external reconstruction concerns now an entity losing its legal identity. So I was using, let's say my name, it's a company, Limited. It's on financial distress. You will find that another company is formed, David Limited is formed to take over now this other company which is on financial distress. So meaning that this company called Edwin Ochoy will lose its legal identity and it will be taken by another entity. So meaning the providers of capital in the old company, they would have to be compensated by the new company. What are the providers of capital in a company? What are the providers of capital in a company?
Debentures.
So shareholders, so preference shareholders, ordinary shareholders, and the loan providers. So they have to be compensated in the whole company. So meaning that when doing the aspect of external construction, the first thing we always do is the determination of the purchase consideration. I think I can clear this. I write something. So external construction. Steps to be followed. So step one, determine purchase consideration. Step two, write off the books. In the old company. I.e., ordinary sundry members account. Preference sundry members account. Debentures account. It has to be written on. Realization account. And we have to prepare additional accounts like purchasers account. You purchasers account. You will find something of this kind. You will come across cash book account. But the one which are common to be written off are ordinary sundry members account, preference sundry members account, debentures account, and realization account. And again, you have to prepare these two addition. This one are the one which maybe for us to complete these accounts, there is somewhere they will be required. Step three. So step three. So step three now is to open the channels of the new company. Open the channel entries. Do the channel anyway. Open the channels for the new company. And finally, step four, you do what? Prepare the statement of financial position. Statement of financial position of the new company. Ukielewa hizo ni hiyo topic ya manga imekwisha. Kuna kitu kingine ni hizo. This was external reconstruction, which was this what was tested in the city August 2022. That is the question I will start with. Any question? before I end the session, we start from here. In our next class. Any clarification needed?
Excuse me,
Yes.
could you please share today's class? I was kind of getting kicked out classes.
I will share later. Yes.
Also, the marking scheme of the insurance question.
So insurance question, today's class recording, and yesterday recording. I have not shared that. I know.
Okay.
That's all.
What's the assignment for today?
You are saying?
Today's assignment.
For today's assignment, maybe I want to pay other